Hello, very good morning to all and happy Friday. I'm Kelvin here again. Very good morning. Today will be Friday, the 14th of June 2024. Welcome to our Daily Dose of Market Insights for today. So before we start our Daily Dose, as usual, let's take a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term intraday technical outlook on the major US stock indices, the major US dollar pair, and as well as the two key commodities, that is gold XAU/USD and West Texas crude oil, let's have a recap what has taken shape yesterday in terms of news flow release, key news flow release, economic data release, and as well as their respective impact on the various cross-asset classes prices. So let's start with the economic data release first for yesterday. So yesterday economic data release was actually centered in on the US PPI data. So that is considered as factory gate input prices, more concentrated towards the manufacturing sector in the US. So what we could see over here is that PPI also came down, cool down, I would say, in the similar deceleration trend of the core CPI data release that was seen a day ago earlier, that was in Wednesday. So this core PPI data came in at 2.3% year on year for the month of May. That is below 2.4% year on year was printed in April and slightly below expectation of 2.4%. So if you look at the core PPI trend, let me flash the data for you guys to see. Okay, 5-year. Okay, so what we could see over here is that it seems to us that it's actually starts to plateau downwards as well. All right, plateau downwards, but it hasn't broke below the low of December 2023, at which is at 1.8%. So one thing kind of encouraging in the state of what you call it factory gate prices in US is not hitting up on the upside, which actually translate to potentially the US Federal Reserve could embark its first interest rate cut before 2024 ends. Still recall that those will actually follow our daily dose of market insight yesterday. I do talk about this exposed FOMC impact and their implication on the markets. All right, you can actually take a listen to that video again yesterday, which is on our OANDA Asia Pacific YouTube channel. So with that in mind, if you look at the CME Fed Watch 2, that actually imply based on the calculation or the thinking of futures, Fed funds futures traders action for their price action, it actually inferred that there is still a high chance in the September FOMC meeting, which is 18th of September, pricing is betting odds of 74.4%. So there's a chance of 74.4% for a 25 basis point potentially being cut on the 18th of September meeting to bring down the Fed funds rate from 5.25% to 5% to 5.25%. So that's actually in line with the latest dot plot that was released on the FOMC meeting on Wednesday, where the median projected Fed fund rate implied only a sole interest rate cut in 2024. That was a reduction from 3. But due to this better, slightly, maybe I just put a better word, is that not so hot core PPI data that was released yesterday, that actually increases the chances of another rate cut to come in before 2024 end, that is in December. So you look at 18th of December, there is a odds at 90%, a chance of close to 91% if I round it up, that the Fed fund rate will be at 4.75% and 5% after the 18th of December FOMC meeting. That means that actually imply another 25 basis point cut. So markets right now based on the pricing as inferred from the CME Fed Watch 2 compiled from the price action of the Fed Funds futures market as being traded by the traders. Market is much more dovish in the thinking of the US Federal Reserve officials. So two things could actually happen right now. Either the US Federal Reserve officials go in line with what market is expecting of them to do, or the US Federal Reserve officials will disappoint market again. So that could be a situation when we come closer towards the next meeting in September. All right. So still recall that at the start of this year, market is actually looking as much as 3 to 4 interest rate cut. But the Federal Reserve officials actually disappoint market expectation and tone down their market expectation rate cut market participants rate cut expectation, which is way too dovish. All right, so now the market participants still follow the same behavior again, getting more dovish ahead of the dot plot that was actually penciled in on the FOMC meeting, that the Federal Reserve only kind of give the market a heads up, indicating potentially, not 100%, potentially they're based on their current thinking, their mindset, their median forecasted Fed funds rate only imply only one interest rate cut in 2024, but market is jumping ahead, more dovish, they're pricing in two. So the key story over here is that as the weeks goes by, the Fed what the Fed did over here is that they do not want to give a very concrete forward guidance policy. They keep on saying they will be data dependent. So what do I expect over here is that as new data come in, new slew of Federal Reserve officials speeches, public speeches, that could actually cause more volatility in the market, means i.e. especially on the FX market against the dollar, against the rest of the other major currency, will be trapped in a very broad sideways range configuration. Okay, so that's my take going forward, given the situation that we are looking at it right now. All right, so now this is one of the data that we are looking at yesterday, and how does it impact the market? So if you look at the US benchmark stock indices, is rather mixed. So what we could see over here is that we start to see strong outperformance against the Nasdaq and against the S&P in the S&P 500 and the Nasdaq up 0.23%, and the Nasdaq is up 0.57%. The Dow Jones and the Russell 2000 strangely continue to underperform, negative 0.17% and negative 0.88% on the Russell 2000. So what we could see on the heat map over here on the S&P 500 is us a clearer picture of what's taking shape. So I could see over here yesterday's market performance on the S&P and Nasdaq 100 has been solely led by the mega cap stocks, and everything is being centered in on the AI optimism again, where Nvidia continues to be very, very strong in terms of performance, added another positive day of 3.5%. Whereas if you look at the rest of the other component stock within the S&P 500, I would say that it seems to me there's much more red compared to green at this over here on the intraday basis. So I would say that it's still rather a mixed intraday performance yesterday. If you look into the aspect of dive deeper into the aspect of the S&P 500 components performance and what is actually holding the fort. And also, interestingly, the Dow Jones and the Russell 2000 is not having a positive follow through. So it seems to us that the Dow Jones and the Russell 2000 is actually pretty much concerned about the current state of the guidance that is being portrayed by the Federal Reserve officials based on the Wednesday FOMC dot plot release. That means there is no kind of certainty that the Fed will actually be much more dovish as compared to the rest of the other major central banks like ECB, the bank of the Central Bank of Switzerland, and as well as the upcoming one that could potentially also cut rates will be the Bank of England, perhaps right after the 4th of July snap UK election. Right. So now with that in mind over here is that now let us start to take a look at the intermarket dynamics and as well as the several fundamentals that I have to share with you all. So let's start with the intermarket dynamics of the US 10-year Treasury yield and also its relation with the FX market. So what I could see right now is that yesterday the intermarket correlation actually break down. So what do I mean by this? So if you were to look at the US 10-year Treasury yield, the price action actually broke down below the 4.3% key support level, and which is also the 200-day moving average on a medium-term basis. So very clearly, there's a clear daily close below it yesterday, after it managed to survive the mildly hawkish Federal Reserve dot plot release on Wednesday, because it actually shaped that intraday push down. Then thereafter, it managed to close right at the 4.3. So yesterday, it closed below the 4.3% level. So what it means that over here is that the 10-year US Treasury yield potentially could be now guiding towards more of a softer path going forward from a multi-week perspective, okay, which indicates to us that liquidity condition should start to be less tight globally as well, because the 10-year US Treasury yield represents a global long-term interest rate benchmark, where corporate loans, potentially mortgage loans, and consumer loans is actually based on this 10-year US Treasury somehow or another to price. All right. So if you look at the 2-year one as well, the 2-year Treasury yield, which is a shorter term curve that is much more sensitive to the US monetary policy, has also broken down below the 4.72%, the key medium term support of 4.72%, and also closes below the 200-day moving average, after it also managed to survive after that release of that Federal Reserve latest dot plot forecast. Right, initially the plunge, then stay pushed down. So if you look at this situation over here from a, I would say, normal intermarket dynamics, it should actually translate to a weaker dollar. Why? Because it implies to us that liquidity conditions should start to get less tighter, and in fact, it should be on the path, gradual path of loosening in the coming weeks, based on the breakdown of the 4.72 on the 2-year and the breakdown of the 4.3% on the 10-year. But what's interesting over here is that the dollar doesn't actually follow the US 10-year Treasury yield yesterday. So instead, the US dollar rebounded. All right. So on the FOMC meeting, upon release of the dot plot, they actually followed very closely on the US 10-year Treasury yield and the 2-year movement. But interestingly, yesterday, the dollar actually rallied and formed a strong bullish Marabuzu candlestick, trading above the 20-day moving average, and right now it's trying to actually also close. In fact, it already closed above the 50-day moving average yesterday. So what you could see now is that it's now trying to break above that 105.20 level. So give a bit about a bit of whipsaw over here. So may I just do a better one. Let's use the candlestick high. Okay, this candlestick high, 105.45. All right, this is the upper limit here. So it seems to us that it's now trying to test this 105.45, and above it, potentially it could see the major swing high that was formed on 16th of April and 1st of May. So what's the reason that causes this traditional intermarket breakdown between the movement of the US Treasury yield and the US dollar index? Is due to geopolitical risk premium that is rising inside the Eurozone. So as we know that Eurozone right now is facing a potential political uncertainty, because several key component right-wing parties are gaining a foothold in the European parliamentary election. So that actually causes one of the key Eurozone member, France, the French President Macron, to call for a snap domestic French parliamentary election. All right, it's not a president election. It's because in France it's a bit different. There's a president election and there is a domestic French parliamentary election to nominate to actually vote for their, put in a way, that the members of the French parliament. So right now, the snap election in French there will be 2 rounds because French is a bit unique as compared to other economy, other traditional election. There are 2 rounds. The first round will come on the 30th of June, right? So it's really confirmed, this one, 30th of June, and followed by the second round on 7th of July. And based on before 30th of June, there is some poster, polling agency that will do a poll among the French electorate, that means the French people, who are they in favor of voting. So yesterday there was this first poll result to release for the first round of the election on 30th of June. Over here is saying that Macron, which is the incumbent, the French president party that has a majority holding power in the current France parliament right now, is losing its stake. Why? Because Macron group only has 18%, whereas Le Pen, this one, she belongs to the far right, is gaining 31%. So this is based on this LB election poll for the first round of the French domestic parliamentary election that's been held on the end of this month, 30th of June. So what it means that over here is that it seems to us that that is getting more and more a sentiment that is now currently skewed towards the right-wing party. So if this turns out to be true, this scenario turns out to be true, that means, i.e., this right-wing party, a bit tongue twisting on Friday, this right-wing party tends to engage in protectionism policy, all right, anti-immigration or whatsoever, and potentially they could also start to favor more physical spending in Eurozone as well. That means, i.e., we know that the formation of the Eurozone traditionally is to control rampant, unresponsible physical spending. But it seems to us that based on the last few years of the fiscal stances of such right-wing party, they are actually not in favor of the forefathers of the founding fathers of the Eurozone. They actually wanted to actually spend more, actually to push up individual country domestic Eurozone growth. So that actually doesn't gel well for the European currency. So that's why the euro dollar sell off, that actually causes the dollar strength to actually come back into the picture, that goes against the traditional fundamental intermarket relationship with the US 10-year. So that's actually explained to us, yes, despite the fact that the 10-year US Treasury yield and the 2-year Treasury yield broke below the key medium-term support level, but however, this is not reflected in dollar weakness, but instead the dollar showing strength. Why? Because of the rising geopolitical risk premium in the Eurozone due to this upcoming French domestic parliamentary election, where the poll is now showing that the current incumbent French president, Macron party, he belongs to the centralist party, is losing a very key significant foothold in the French parliament. All right, so that actually explains the breakdown of the intermarket dynamics between the FX market and the US 10-year Treasury yield. So if you look at the where is it? Yeah, so what I want to say over here is, where is this? Yeah, so this will be the situation right now based on the 5-day rolling performance of the dollar against the major currency pair, the dollar major against the rest of the major currency. So what I could see over here is that the euro dollar actually rose sharply yesterday. All right, so that actually not the euro dollar, the dollar against the euro, pardon me, about time 16, the dollar strengthened against the euro significantly yesterday. So the euro was the weakest against the dollar, and it managed to actually drag other dollar pair up as well. So despite the fact that the dollar sterling also went up, and even the dollar Kiwi and the dollar Aussie also rebounded as well to cover that initial gap that was formed after the release of that CPI, that very what you call it, deceleration trend core CPI data in US, but the gap has really kind of been covered against the dollar Kiwi and the dollar Aussie. So then overall, we could see it's more a bit about dollar strength coming back into the picture, at least in the short-term basis. All right, so now this is something I want to share with you all. And what I could see over here is that interestingly, the dollar yen now starts to fall back a bit right now. So it seems to us that what's going on, because today we will have the BOJ meeting, which is, as we are speaking, they should be out really. Okay, because they're released at 11 a.m. Singapore time. Okay, usually even get rapid news, right, I tend to go to Forex Live, okay, to see has the news been released or not. Okay, it seems to us that it's not released yet. See, it's not released yet. Okay, so the news is not released. All right. So if you go to the calendar, right, let's look at the calendar. Okay, it's not released yet, because usually they put it at 11 a.m., but it's not usually always right exactly at the dot of 11 a.m. Okay, where is it? Yeah, it hasn't released yet. All right. So the key situation over here right now, maybe let me talk about BOJ over here. So BOJ interest rate decision for today is market is expecting no change to their interest rate. Still recall that in March they actually start their pace of nimble normalization away from decades long of ultra dovish accommodating monetary policy. So that they're right now trying to play a catch up to go by baby steps to slowly increase their interest rate back to positive, because they have been negative interest rate for decades, right? So they actually make the baby step 0.1% on their overnight benchmark rate. And interestingly, they also starts to remove the YCC program as well. So what I mean by YCC program, initially they use the 10-year JGB yield, the upper limit, they cap it at various level, and the last meeting in March, they totally removed the YCC, but however, they continue to be in the JGB market where BOJ will continue to monitor the pace of movement on the JGB yield, because they do not want to have a very strong push up in the JGB yield that could disrupt the dynamics of the JGB market, and potentially it could actually disrupt the entire financial system in Japan. So they actually every now and then they will be in the JGB market to continuously buy in JGB bond. So that is actually not a really letting go of their ultra dovish monetary policy. So at that point in time, market participants are still saying that, hey, you guys are still doing a stealth QE program. But however, for today, what market is expecting over here is that they're actually looking at to reduce their bond buying for today. Okay, so this is their expectation. So right now, right, market is actually gaming. There's a few gaming right now. Yeah, over here. So at the moment in time, they are actually buying around 6 trillion JGB bonds. So some of the market participants are predicting a reduction to 1 trillion or less, by 1 trillion or less. Okay, not to 1 trillion or less. Okay, so if it starts to be this situation over here, that could be a reaction to the yen and the bond yields. That means the bond yields could start to spike up, and that could actually potentially see the yen strengthening slightly against the dollar. So that actually explains what we saw on the 5-day rolling performance chart. Okay, well, it spiked up. Okay, so the dollar yen spike up again. So right now, what we could see over here is, in fact, they actually didn't reduce the JGB bond buying, so that causes the dollar yen to spike up. All right, it should be the case right here right now, because or else there's no clear spike of the dollar yen. All right, so with that, right, let us now straight away jump straight to the short-term intraday market outlook, the technical outlook, starting from the FX market first. So on the FX market over here right now, let us start with the euro dollar. So the euro dollar yesterday, we do have a short-term intraday bearish bias, all right, below the 20-day moving average, and it came down and hit the support level as we highlighted on yesterday short-term intraday technical outlook. So still no change. Very clearly now the price action now has traded below the 20-day moving average, the 50-day moving average, and also breaking below the 200-day moving average as well, with a daily close below it. And what we could see over here is that there is also no clear signs of a bullish divergence on the hourly RSI, despite it hitting the oversold region yesterday. All right. So with that, potentially now there could be a minor bounce back up. Why? Because of its oversold condition on the RSI that it got to work out. So a potential minor bounce, first resistance to watch will be at a 50-day moving average that's acting as a resistance at 1.077 over here. So what I'll be using there, I'll be using a Titan key short-term pivotal resistance for today at 1.08 level. This level here, this minor congestion, pretty much clear for you guys to see on 13th of June, where it actually congested and it led to that rapid sell-off yesterday on the intraday basis. And also, if we do the Fibo retracement of this sell-off from this Wednesday all the way up down to yesterday intraday low, it also confluence with the golden ratio of that 0.618. So as long as this potential minor bounce didn't surpass above 1.08 short-term pivotal resistance that we highlighted, that we tightened to on the euro dollar for today, we will still maintain that short-term intraday bearish bias on the euro dollar. First support level to watch will be the minor swing low of Tuesday, 11 on June at 1.072. A breakdown below it exposes 1.0685, and further it may expose the key medium-term support area of 1.0656. Why is it key medium term? If you go to the daily time frame over here, it's a bit slower. It's actually the this potential medium-term symmetrical triangle range support level that I drew from the low of 2nd of October 2023 that will confluence at the 1.0656 level. All right, go back to the daily chart, out the hourly chart. All right, only an hourly close above 1.08 figure level today will invalidate today's intraday bearish bias on the euro dollar to potentially see a squeeze up to retest the 20-day moving average, acting as a resistance at 1.0835. Above it may expose the next near-term resistance at 1.0860. All right, so now let's go to the sterling dollar. So with that, let me expand my screen so that you guys could see. So on the sterling dollar over here, the price action also going to ease down and now tested the 20-day moving average. So it's still performing much better compared to the euro dollar. Why? Because it's still trading above the 20-day, the 50-day, and as well as the 200-day moving average. But however, if you look at the bigger picture chart on the daily chart of the sterling dollar, there is actually a bearish reaction over here. Yesterday's bearish candle right exactly off this major descending trend line that I drew from the high of 13th of July. All right, it bang off it. And if you look at the RSI as well, the daily RSI has started to shape a very clear bearish divergence. All right, as price action managed to inch upwards since 28th of May to 12th of June on Wednesday, but the RSI is not shaping the same price action with the price action on its raw price data, whereas the price action on the RSI is sloping downwards, indicating to us that this medium-term bearish momentum is gaining a foothold into the sterling pound, and which means, i.e., that support that is being supported by the 20-day moving average on since 10th of June is now losing potential strength due to the bearish divergence that's being flashed out on the daily RSI. So given this key bearish technical element on the higher time frame chart, I will still maintain that short-term intraday bearish bias on the sterling dollar. using a tightened key short-term pivotal resistance for today at 1.2810 level. So as long as this level is not surpassed to the upside, maintain the short-term intraday bearish bias. First support level to watch would be close to the 20-day MA at 1.2610. That also confluence with the lower limit of this minor ascending channel that I drew from the low of 22nd of April this year. Okay, so a breakdown below 1.2730 potentially exposes the next near-term support at 1.27 figure level, which very clearly tested 3 times on 31st of May, 3rd of June, and as well at 10th of June. Further break below it exposes the 1.2645 support next, which is very close to the rising 50-day moving average as well. Only an hourly close above 1.2810 will negate this short-term intraday bearish bias to potentially see a squeeze up for the next near-term resistance to come in at 1.2860, followed by the 1.29 figure is if the 1.2860 is being taken up on the upside. Right. So now very quickly, let's take a quick look at the dollar major against the Asia Pacific country. Is it against the Asia Pacific, especially on the dollar yen? So what I could see over here is that very clearly the dollar yen has already broken up above the 15760 short-term pivotal resistance. So very likely is that the Bank of Japan did actually reduce the JGB bond buying program that causes this push up. So what I could see, because this level is being taken out, I got to respect the price action, okay, and flip to a short-term intraday bullish bias. So recall that yesterday, this is the short-term pivotal resistance, and this is the kind of a first support level it got to break before retesting the 50-day moving average. And what's interesting over here is that yesterday it managed to bounce off the first support level that we highlighted. So this level here for sure will be the short-term pivotal support that I will use for today. All right, 155. Okay, give me a minute. Let me put it in. Oops. Okay, so this level has been taken out. Okay, okay, it's a bit slower. Okay, let me put it in text form. Good, okay. 156.60 ST pivot. Okay, so this will be my short-term pivotal support for today on dollar yen. So giving us a very strong push up above 157.50. So I got to respect the bullish price action. Flip to a short-term intraday bullish bias on the dollar yen. Over here, a breakout above 158 figure level, which is the clear minor swing low, okay, of 1st of May that causes this steep decline on the dollar yen on the intraday basis due to this the dollar yen BOJ intervention, where they actually brought yen sell the dollar that causes this drastic pull. A break above this level could see a test on the lower limit of the long-term pivotal resistance at 159.50 level. Right, only an hourly close back below 1560 will invalidate today's intraday bullish bias on the dollar yen to see it floating down towards the lower limit of this sideways range configuration, which is the 50-day moving average, I think, as conversing with the next near-term support zone at 155.80/155.40. Okay, below it exposes the minor swing low of 4th of June at 154.60. All right, so Aussie dollar. So Aussie dollar continues to float down as expected over here. So what I'm going to do right now over here is that I will tighten the key short-term pivotal support level to 66.80 for today. Okay, let me. Okay. What's going on? It's a bit slow right now. Okay, let me explain first before I do the key in. So I got to remove this to make it clear. Okay, so my apologies. Okay, good. Okay, oops. what's going on. Okay, good, it's back. It seems to me that it doesn't allow me to change the settings. Okay, let's wait for a while, a few seconds. Hopefully I can make it more clearer for you guys. Okay, it doesn't allow me to. Okay, I don't know what's going on today. Okay, let me explain in words so you could see it clear. So 6680 will be the Titan key short-term pivotal resistance for today on the Aussie dollar. Why? Because that was the spike up on the intraday. Okay, finally I can change input this. Okay, short-term pivot. Okay, so this will be no longer the short-term pivot for today. Okay, that was yesterday's level. Okay, so as long as 6680 short-term pivotal resistance holds, so that was yesterday's intraday spike up, can't break up and you shape a series of lower. So 6680 short-term pivotal resistance still maintain that short-term intraday bearish bias on the Aussie dollar. Support level to watch will be at 6610. A breakdown below it exposes 6580 for today. All right, so that should be the intraday basis levels to watch. So that will be the swing low of 10th of July. Only an hourly close back above 6680 will negate this bearish bias intraday view to potentially see a retest of 6710/730. So 730 is the upper limit of the key medium-term symmetrical triangle range configuration that has so far kept the Aussie dollar from shaping a rally further upwards since 28th of December last year. Okay, so this is the upper boundary of this medium-term symmetrical triangle that is now acting as a resistance at 730. All right, so net overall, what we could see right now on a short-term technical intraday outlook basis, it seems to us that dollar strength seems to be resurfacing on at least on the intraday bias for today. All right, now FX market, done with the FX market. So now let us move on to the major stock indices, starting with the Asia currency, the Asia major stock indices first. All right, let us start with the Japan 225. All right, so the Japan 225 yesterday returned neutral because they managed to trap between the 20-day moving average and the upper limit of the range resistance, the minor range resistance since 11th of June. So interestingly, yesterday it broke down below the lower neutrality range, hit the support level, which is the 50-day moving average, before it shaped that bullish reversal hammer candlestick during the US session, and it managed to bounce off. And today, right now, it managed to clear above the 20-day moving average. Okay, as we are speaking, have an hourly close above it with a strong bullish Marabuzu candle as we are speaking right now. So this will be kind of a first support level on an intraday basis to watch out for, but it shouldn't be the short-term pivotal support because it's a bit tight. So I rather use this 38,550. Why? Because it corresponds to a couple of technical elements. Very clear minor swing low of 7th of June over here. And if we do the Fibo retracement of the last minor rally from 30th of May all the way up to 11th of June, it also corresponds to the 50% Fibo retracement as well. Okay, so I will use the 38,550 as my short-term pivotal support level on the Japan 225, or i.e. the Nikkei 225, to maintain that short-term, to flip to a short-term intraday bullish bias on the Japan 225. First resistance to watch 39,290. Above it potentially exposes 39,500, which is the which is the swing high area of this level here. Okay, it's a bit slower. Okay, this area here very clearly there's some this congestion here. The swing high of 15th of April and as well close to 20th of May at 39,500. Only hourly close below 38,550 will invalidate today's intraday bullish bias on the Japan 225 to see another round of choppy corrective decline to expose the next near-term support at 38,290. Below it sees 37,960. All right. Moving on will be the Hong Kong 33 index or the Hang Seng index. So still no change, still managed to bounce off the 50-day moving average, which is also our short-term pivotal support that we had yesterday, 17,895. So still no change, still using the 17,895 as my short-term pivotal support level to maintain that short-term intraday bullish bias. So right now, it seems to us that there is actually a near-term resistance level we got to clear, which is yesterday's US session high. Okay, oops, at this 18,155. Okay, only a breakout above 18,155 exposes the next near-term resistance at 18,380. But however, if we start seeing an hourly close below 17,895, will invalidate today's intraday bullish bias to see the continuation of this minor corrective decline to expose the next support at 17,600. A breakdown below it potentially exposes the 200-day moving average. We're so confluencing at this graphical support at 17,170. Okay, moving on will be the European indices, German 30 or the German DAX. So the German DAX managed yesterday was actually pretty much drastic. It actually sell off, okay, due to that political risk premium that is playing out in Eurozone. So that has also made our expectation, because yesterday we flipped to a short-term intraday bearish bias, hitting the swing low area that was being supported previously on 4th of June and 11th of June. So upon hitting this level here, the price action of the hourly RSI hit the oversold level, but there's no bullish divergence that is being formed. And this dotted line here is very, very key. Why? Because if we go to the daily time frame over here, let's go to the daily time frame so that you guys could have a better picture. So on the daily time frame, it clearly broke down below a major trend line, ascending trend line support that I drew from the low of 27 October. So the clear daily close below it. And if you look at the hourly, now the daily RSI is also bearish as well. All right, continue to shape a series of lower high and now breaking below the 50 level mark. Haven't still got a lot of room to go before hitting the oversold region. So with that longer term bearish element that is being depicted on the daily time frame chart, we will still maintain that short-term intraday bearish outlook on the German 30 index or the German DAX. So, but however, that could be a bit of minor bounce taking shape. So the short-term pivotal resistance, I will tighten it today to 18,400 level, which confluence with the pullback line of this former major ascending trend line support. This dotted green line here now turns into a pullback resistance. And if we do the Fibo retracement of the entire sell-off, intraday sell-off from Wednesday all the way down to yesterday's swing low, it corresponds to the 38.2% Fibo retracement. All right, so 18,400 will be my short-term pivotal resistance for today to maintain that short-term intraday bearish bias on the German 30. First support level to watch will be yesterday's swing low area, 18,240. A breakdown below it exposes the next near-term support at 18,120 next. However, if I have an hourly close above 18,400, then it will invalidate today's intraday bearish bias. Potentially, we could see a messy, choppy, corrective bounce back again inside this range configuration over here that is in place since 30th of May. Next resistance to watch in the near term will be 18,520. All right, then followed by this 18,640 / 18,685. Minor swing high area of 12th of June, and as well as this medium term descending trend line that I drew from 16th of May. Okay, now moving on will be the US Wall Street 30 or the Dow Jones Industrial Average, going to be very, very weak. So what you could see over here, it continues to trade below the 20-day and the 50-day moving average. So yesterday it smacked down, hit the first support level before rebounding, but the rebound is kind of getting lackluster as well. The price action, no bearish divergence. So what you could see over here is that potentially there could be still some form of intraday weakness coming back into the Dow Jones Industrial Average on a short-term intraday basis. So what we will do over here is that we will still maintain that short-term intraday bearish bias, except that we will have a tightened key short-term pivotal resistance for today at 38,875. What's this level? This level was actually kind of intraday. It tested on yesterday, on Wednesday, this level before it took that sell off during the start of the yesterday US session. Okay, and also now should be close to the 20-day moving average as well. All right, so as long as 38,875 short-term pivotal resistance holds for today, still maintain that short-term intraday bearish bias on the US Wall Street 30. A break below 38,420 exposes the next near-term support at 38,280. Below it sees the minor swing low area of 30th of May and 31st of May at 38,030. Only an hourly close above 38,875 will negate today's intraday bearish bias to see the next resistance coming in at 39,130. Okay, which is the range top area of 7th of June and 12th of June. Above it potentially exposes the next resistance at 39,390, which is this former minor swing low of 14th of May and for 15th of May, now turns into a pullback resistance. So that's for the US Wall Street 30. Now, heading on next will be the NASDAQ 100. Yes, despite NASDAQ 100 yesterday making a fresh new all-time high, but what we could see over here is that momentum has started to turn weak. How do we know? By looking at this bearish divergence that's being formed on the hourly RSI. So with that, still no change. I'm still using the 19,800 level as my short-term pivotal resistance level for today. Potentially there could be a chance of a short-term minor mean reversion pullback scenario that could unfold. So that will be still maintaining our short-term intraday bearish bias for this potential mean reversion, minor mean reversion scenario. So what we'll have, I will have a kind of a first support level to watch for today, which was yesterday's intraday low, okay, which is at 19,490. A breakdown below 19,490 will increase the odds of this mean reversion, minor mean reversion decline scenario. Next support level to watch will be at 19,240 level. Okay, 19,240 level. All right. Below it sees 19,100 next. Then thereafter, if it starts to clear below 19,100, then this minor mean reversion pullback will be much more steeper to kind of retest the 20-day moving average that is also confluencing with the support level at 18,910. Only an hourly close back above 19,800 will invalidate this short-term intraday bearish bias on the NASDAQ 100 to see the continuation of the impulsive up move towards the next near-term resistance at 19,990. Then above it sees 20,120/155. All this resistance level is being defined by Fibo extension level, clustering level, because the NASDAQ 100 now is trading at a fresh all-time high. All right. Now, so what we could see over here is overall pretty mixed bag intraday technical outlook on the major stock indices. So now let's go to the commodities market, starting with the gold XAU/USD. So for gold over here, it's also moving in line with a stronger dollar, rather not with the push down in the US 10-year Treasury yield. So we know that gold itself also have a direct inverse relationship with the US dollar. So with a stronger US dollar in play on a short-term intraday basis, the gold also going to trade downwards, hit our first support level at 2,300 before bouncing off during the later part of the US session. So overall over here, the RSI continues to be rather lackluster. All right. Okay. And it continues to hold below this resistance level. Okay, eventually hasn't even hit the oversold level yet. So potentially the RSI seems to be indicating to us that short-term intraday bearish momentum seems to be still intact. So with that, because it hasn't broke below that 2,300 level, I don't want to tighten the key short-term pivotal resistance to be so tight at 2,320. So 2,320 will still be my first resistance level to watch. Still use that 2,338 level as my short-term pivotal resistance level to maintain that short-term bearish intraday technical outlook on gold XAU/USD. Next support level to watch after 2,300 will be 2,280/2,270 next. Only an hourly close above 2,338 will invalidate today's short-term bearish bias outlook on XAU/USD to potentially see another round of rebound. Right, next near-term resistance to watch will be at 2,345, followed by the minor swing high of 7th of July that triggered this leg of minor corrective movement. The swing high will be at 2,386. That's all for gold. Let's move on to West Texas oil over here. So on the daily chart of the West Texas oil, what it could depict us is still rather weak. So price action yesterday managed to form another small candlestick body. So it's like another shooting star, bearish shooting star, right at the 78.40 resistance level, which is the pullback of this former medium-term ascending channel support now turns into a resistance from the low of 13th of December last year. So given this bearish candlestick formation that is formed right exactly at a key resistance level on the daily time frame, we will still maintain that short-term intraday bearish bias on the West Texas oil. So still using that 79.45 level as my upper limit of the short-term pivotal resistance level. First support level to watch for sure, it got to break below 77.60, which is the 20-day moving average. I think that's support as well. A breakdown below this level exposes the next near-term support zone of 76.70/76.30 on a intraday basis. Only an hourly close above 79.45 will invalidate today's intraday bearish bias on the West Texas oil. Only then thereafter, potentially we could see a retest of the minor swing high of 29th of May at 81 figure level, and above it exposes the next resistance at 81.90, which is the congestion area over here from 23rd of April to 1st of May. Okay, so that sums up the short-term intraday technical outlook on the key cross asset classes. So now let's take a look at the calendar before we go. All right, so the calendar over here, what are the key economic data to watch out for today? What we could see over here is that pretty quiet during the European session, except that we have two European officials speaking, ECB Guindos and ECB Lin speaking at 5 p.m. Singapore time over here. Then thereafter, we do have another ECB official speaking, 9:30 p.m. ECB Schnabel speaking, and the key data to watch out for during the US session will be the release of the flash consumer sentiment data from Michigan, University of Michigan, flash consumer sentiment data for June. So that will also consist of the inflation expectation data as well. So something to keep an eye watch for, especially the inflation expectation, given the fact that oil prices in the last 3 or 4 weeks has started to slow down below the $80 barrel mark. All right, so with that, that sums up today's daily dose of market insights. So I'm Kelvin here signing off. So I wish you all a great restful weekend, and we should speak again on next Tuesday instead. All right, because on next Monday, 17th of June is a public holiday, so we will resume our daily dose on the 18th of June, which is on next Tuesday. So with that, I wish you all a great weekend. Thank you.